They say transparency is key, but is it really? The SEC approved a new actively managed, non-transparent ETF that could revolutionize the way you invest. For more on that, let's bring in the man behind this ETF, Stuart Thomas, president at Precidian Investments. Tom, explain this to us. Generally, we, of course, covering ETFs for 20 years as I have, you disclose your holdings every day. It's what we call transparent. Now the SEC has approved a new set of ETFs where you don't have to disclose them every day. You're going to be running that through your company. Active shares will be the one. Explain briefly how this works and why does the public need this or want this?
Great. Bob, thanks for having me back, and good afternoon, everybody. Precidian Active Shares is the first and only approved, but only SEC approved ETF that seamlessly integrates the benefits of active management with all of the efficiencies of today's ETFs. Works just like a traditional ETF. Creations and redemptions happen in kind on a pro rata basis. We think that's incredibly important from both a market-making standpoint, also from a tax efficiency standpoint.
Yeah.
So,
except, Tom, the ETFs that are passively managed certainly disclose, and some of the active ones disclose their positions every day. These will not.
Yeah. So transparency's, a big deal. But I think what you're finding, Stuart, is there's so many companies, big money managers who've built their business on mutual funds that are now saying, hey, I missed that passive train, but now I want to take my active strategies, and a lot of it, it's not either or, it's not mutual funds or ETFs, it's choice, it's a little bit of both. Now they can take these active strategies, put an ETF wrapper around it, not have to lift up the hood every day and show what's underneath, correct? But the thing is, those of us in the business question the plumbing, because is it still going to work? So give us some confidence that this still will work the way our traditional ETFs work.
Tom, that's a great question. ETFs have been around for about 30 years. I think in everything we've worked on, whether it was GLD or the first currency share-backed ETFs, we think simple is the best solution. And I think the elegance in this solution is the actual simplicity. Works just like Spider does. Creates and redeems in kind. From the standpoint of the broker or the end user, it looks like any other ETF on the exchange. The only difference, there are two major differences. Number one, we've dramatically improved on the industry standard intraday indicative value. Instead of putting out stale indicative values, we're actually giving 1 second snapshot.
Yeah, so in 1 second versus now ETF Marketplace is 15 seconds, correct? And then you've also added this authorized participant representative who is your trusted partner here, who will know how that basket is created. They will know the underlying, and then they will, on behalf of the issuer, put the baskets together, correct?
So the only change happens on the professional side, on the AP side, to your point.
Yeah.
The fund manager is going to engage what we're calling a trusted agent or an authorized participant representative. They're the only ones that are going to know what the constituents are on a daily basis.
Yeah.
APs will be required to set up accounts at the APR for purposes of creation and redemption activity only. And that APR will only be able to trade on an agency basis.
Yeah, I'm not so concerned with that. I think that possibly could work. What I'm more concerned with is active managers in mutual fund structure are losing clients. They're coming into ETFs. Partly, sometimes they just want passive because active management has not been that successful in the last decade. We know that. Partly because they're looking, even if they stay active, for the lower cost mutual fund structure. I guess the question is, how successful is this going to be? Now, you've signed up all sorts of, there's interest out there, right? So there's, at least at the outset, there's interest.
I think we truly underestimated how big this was going to be. Our phones are ringing off the hook. These are active managers calling us. We have no time for outgoing calls. The entire ETF ecosystem, from custody banks to market makers to the people that want to do the AP representative role. And Bob, you said they haven't performed, but in fairness, they've been at such a disadvantage. The mutual fund's been around since the Securities Act of 1940.
I know, but explain this to me again. Could you take an actively managed mutual fund right now and just convert it into this ETF structure? Could you legally do that? You'd have to have a shareholder vote, wouldn't you? I mean,
you definitely need a shareholder vote. There are 4 law firms that are currently working on just that. It's a question we get from every one of our licensees and every one of our potential licensees. So I see the potential down the road for big conversions in some case, but mutual funds not going away.
Yeah.
Right? The manager should be agnostic
is
about
this
the
going
route.
to be, and Christian, I just want your thoughts in 30 seconds. Is this going to result in active management with lower costs? So if suppose you have an active manager in a mutual fund, he moves his strategy into an ETF. Instead of charging 100 basis points, is he going to charge 30 basis points? Do we know? Is this actually going to be a lower cost structure?
I think different issuers are going to take different approaches, but we've always said there's this misconception that if it goes into an ETF, it has to be lower cost.
But just the tax efficiency alone.
Hold on one second, Christian. I just want to get your thoughts here because we've been sort of going around.
So here's what I think is interesting. 25 largest active money managers, about half of them don't have ETFs. Many of them are active. So that could be a great target market. It expands the ETF tent. The challenge is advisors who use ETFs today tend to be index or passive centric, not active centric. So I see this as more of an expansion of the ETF tent for issuers as well as users. That's going to be interesting to watch.
I have no problem expanding the ETF tent, but I remember efficient tax structure and generally lower costs is the whole point. The reason these guys didn't do very well in the last few years is high costs and no outperformance. You could put it into a lower cost structure. That would address 50% of it. Now you can get the outperformance. Now you've got to actually perform at this point. And that's not your business, that's their business, obviously. You're just giving them a structure.
We're giving them the structure. Remember, though, they didn't have the same tax advantages. Mutual funds, cash drag, had to keep 3 to 4% on hand to meet redemptions. I don't need to do that anymore.
Who's going to your first client going to be? Can you tell us who's going to actively bring it out here?
We've already seen 2 filings. American Century and Gabelli are out there. We've got 10 licensees.
And you're owned by Legg Mason, is that correct?
Legg Mason owns just under 20% of us.
Okay.
We'll be bringing out funds in conjunction with them. But we've got BlackRock, we've got Capital, we've got Nuveen, we've got Nationwide. And since we were approved 3 or 4 weeks ago, we've put out another 20-something contract.
We got to go, but what's preventing anyone from just creating an actively managed ETF structure now and not use active shares? I mean, we've got some actively managed ETF. We've got some big actively managed bond ETFs, mints out there. This is a different situation.
Right. So we've developed a lot of IP around this with patents, and so licensees are buying our patents and our know-how.
Okay, that's it. Fascinating subject. We waited for a long time for this.
Yeah.
Again, being the old school guy, passive, lower cost, I believe the ETF tent, Christian, is a big tent. So
it's going to be fun to watch.
I just want to see the outperformance. Better, lower fees is better too, by the way.